So you're running a business. How much money should you borrow? It's a massive question, right? Get it right and you can fuel incredible growth. Get it wrong, and it could be disastrous. Today, we're going to demystify this critical balancing act. And look, it doesn't matter if you're running a food truck or a global tech company, this question is absolutely central. A little bit of debt can be the best thing that ever happened to you, but too much can sink the whole ship. So where do you draw that line? That's what we're here to figure out. So here's what we're going to cover. First, we'll start in a kind of theoretical perfect world and see how real-world taxes completely change the picture. Then we'll get into why debt is such a double-edged sword. After that, we'll hunt for that elusive sweet spot, see how all this plays out with actual companies, and finally, wrap it all up. Let's dive in. All right, so to figure out how companies make these decisions today, we've actually got to take a little trip back in time to a much simpler, almost imaginary world cooked up by economists. Okay, so a couple of Nobel Prize winners, Modigliani and Miller, came up with this foundational idea. They said, hey, in a perfect world, no taxes, no risk of bankruptcy, it just doesn't matter how you fund your company. All stock, a mix of stock and debt, they argued the company's total value would be exactly the same. But, of course, that's not the world we live in. The real world has this one tiny, well, actually massive, wrinkle that changes everything. And that wrinkle is corporate taxes. This one factor pretty much blows that perfect world theory right out of the water. And that brings us to the very first and maybe the biggest advantage of borrowing money. It's called the tax shield. Here's how it works. When a company pays interest on its loans, it can deduct that interest from its taxable income. So more debt means lower tax bills. That savings is real money, which makes debt a cheaper source of funding than selling stock. This is our first big clue. Okay, so if debt saves you money on taxes, why not just borrow as much as humanly possible, right? Well, here's the catch. Debt is totally a double-edged sword. It can help you a ton, but it can also hurt you badly. And that catch, that balancing act, is the whole idea behind what we're talking about today, the trade-off theory. It basically says that companies are in a constant state of weighing the good against the bad, trading off the tax benefits of debt against the growing risks of getting into financial hot water. So let's break this down. On one side, you've got the benefits. We just talked about the tax shield. That's huge. But there's also this idea of managerial discipline. If you have to make that debt payment every single month, no matter what, it forces you to be smart and not waste money on silly projects. But on the flip side, the costs are serious. The more you borrow, the higher your risk of bankruptcy. And even if you don't go bankrupt, just being in financial distress is awful. You might lose customers, good employees, and suppliers will give you terrible terms. It can be a slow, painful bleed. Now don't worry, we're not going to do a bunch of complex math, but you can think of it with this simple idea. A firm's total value is its baseline value plus the value it gets from that tax shield minus the potential cost of everything going wrong. The name of the game is to make that final number as big as possible. So think about it. If you're adding something good, but also subtracting something bad, there has to be a point where you get the best possible outcome, right? A point where the benefits are kicking in, but the risks haven't gotten out of control. That's the sweet spot we're looking for. And that sweet spot has a name: the optimal capital structure. This is like the holy grail for a company's finance team. It's the exact mix of debt and equity that makes the company as valuable as it can possibly be. And this chart just lays it all out perfectly. Look, when you have very little debt, you're not taking full advantage of those tax benefits. You're basically leaving free money on the table. As you add more debt, the value of the firm goes up, up, up until you hit that peak. That's the sweet spot. But then, if you go too far, the fear of bankruptcy starts to creep in, those costs of financial distress get bigger, and boom, the firm's value starts to drop off. And here's what's really cool. Right at that peak value, something else amazing happens. The company's total cost of funding, what the finance pros call the weighted average cost of capital, or WACC, is at its rock bottom lowest. You're getting the cheapest money possible, and that is a massive competitive advantage. Okay, so this all sounds nice and neat on a chart, right? But the real world is way more complicated. That optimal point isn't some universal number. No, it's completely different for every single company out there. This table makes it super clear. Think about your local power company. They have predictable cash flow month after month, and they own massive power plants, stuff they can use for collateral. For them, yeah, they can handle a lot of debt. But now think about a brand new tech company. Their income is all over the place, and their biggest asset might just be a brilliant idea. For them, taking on a huge loan would be way too dangerous. So if you're a chief financial officer, you're constantly juggling all of this stuff. How stable is our income? What do we actually own? How crazy is our industry? You're thinking about all these things to figure out where that sweet spot is for your company right now. All right, let's pull all these threads together. This is the final balancing act. What's the one big idea you should walk away with after all of this? If you only remember one thing from this whole explainer, make it this. Debt is good. Until it's not. It's an incredibly powerful tool for creating value, but you have to know when to stop. Push it too far and it becomes destructive. It's all about finding that just right amount. And in the real world, nobody is trying to hit one single perfect number down to the decimal point. It's more about having a target range because the economy changes, interest rates move, new opportunities pop up. Companies have to be nimble, always ready to adjust and rebalance. Which leaves us with a final thought to chew on. Is finding that perfect balance a final destination you can just arrive at and say, we're done? Or is it more of a constant journey, a perpetual tightrope walk of adjusting and making trade-offs? Thank you for watching.